Ever wondered how so many countries got through hard and difficult times, such as crisis? Yes, some finish, of course, some do. But how do the others get through the hard times? Well, the answer lies in policies. The governments use monetary and fiscal policy to control their country's economy. But the first question is, what is monetary and fiscal policy? Monetary and fiscal policy are two distinct tools that are used by central banks and governments to manage and stabilize their country's economy. Now, though monetary and fiscal policy are two separate tools, they often work in tandem to support economic growth and development. Central banks and the government often coordinate their efforts and they coordinate their efforts to achieve macroeconomic objectives such as lowering unemployment, controlling inflation, fostering sustainable economic development. But now the question arises that why do we need monetary and fiscal policy? Now I know that most of you have not been through very hard times like crisis, the very terrible crisis, but a very good example of a crisis was that COVID-19 crisis, which was a very big one because of the coronavirus. It's just spreading all over the world. It's a dreadful pandemic. Now, that was a very good example of a crisis, but there are worse crises than just that, you know. So, the thing is that maybe some of you might have not felt much of a crisis because most of the people were not affected by that virus, but many people that are related to me and many people that are related to you guys too have got the flu and got the pandemic. So the thing is that maybe you just think that that crisis was not much of anything at all, but let me make you understand what is a true crisis, like the oh my god, hell has happened kind of crisis. Well, a crisis is when a country's economy falls, or shall I say more specifically, a country's GDP falls, resulting in a shortage of money, which results in a shortage of necessities, which results in death. Because if you run out of food, that's the worst thing you can get into. So, the thing is that in crisis, what happens is that countries lose their balance. So the countries need to restore their economic balance. Now, first, the governments need to supply currency to their country, so they need to print money. But if printing money gets out of hand, then the country will set into a hyperinflation, which even worsens the situation. So, a wise government will do a combination of tactics combined as a policy, and actually they will choose between monetary and fiscal policy because it will depend on the severity of the situation. Hey guys, I'm Mahira, and today's topic is monetary versus fiscal policy. But before I start telling you all about them, well, I'm going to tell you the key differences between them, because by understanding their key differences, you will understand their key meaning and key purpose too. So, before I start, let me remind you that like my video and subscribe my channel. And when you subscribe it, also click the notification bell, because then whenever I create interesting videos like this one, you will get a notification. Don't worry. So you can watch my video whenever it is released. So, but before I go, do not forget to subscribe my channel and like this video if you haven't done any of these yet. So now let us discuss the key differences between monetary and fiscal policy. So now we're gonna discuss the differences between monetary policy and fiscal policy. Now these two policies have differences, many differences, but they are often measured on different scales. So let us learn each of those scales one by one. Now let us start with the most basic scale of all, the authority. Now in monetary policy, it is the central bank, such as the RBI in India, the Federal Reserve or Fed in short in the USA, or the European Central Bank, in short ECB, in the Eurozone, who are responsible for implementing and formulating the monetary policy. But in fiscal policy, you guessed it, the authority is different. In fiscal policy, the authority is the government. Fiscal policy is determined by the government, typically through the legislature and the executive branch. In most countries, the Finance Ministry or Treasury Department plays a decisive role in designing and executing fiscal policy. Now that the authorities are different, of course, the central bank will be able to do different things which the government won't be able to do. And the government will be able to do different things which the central bank will not be able to do. So both of them will have different focuses in their policies. So first let us talk about the focus or objective of the central banks in monetary policy. Now, the primary objective of monetary policy is to control the money supply, interest rates, and credit conditions in the economy. The aim is to achieve price stability, promote economic growth, and maintain low unemployment levels. Now let us talk about fiscal policy. Of course, its focus will also be different. Now, fiscal policy focuses on the government's income and spending decisions. It involves using government spending, taxation, and borrowing to influence economic activity, stabilize the economy, and accomplish various social objectives. So, in short, monetary policy and fiscal policy might seem the same, but they are very different. So the first most basic scale is the authority. The authority that is responsible for formulating and implementing the monetary policy is the central bank, and the one responsible for formulating and implementing the fiscal policy is the government. Also, the fiscal policy is determined typically through the legislature and executive branch, and also the Finance Ministry or Treasury Department plays a crucial role in designing and executing the fiscal policy. And monetary policy has the primary objective to control the money supply, interest rates, and credit conditions in the economy. And the aim is to achieve price stability, promote economic growth, and maintain low unemployment levels. But fiscal policy often focuses on the government's income and spending decisions. It involves using government spending, taxation, and borrowing to influence economic activity, stabilize the economy, and accomplish various social objectives. Okay? Now let's jump to the next scale. Now the next scale is the tools. How will the central bank or the government be able to implement a monetary policy or fiscal policy? Well, there are three main tools for the central bank and the government to use. But those three tools are very different. Let's see what those three tools are. Now first let's start with monetary policy. The first tool is open market operations. Now what is open market operations? Well, in open market operations, the central banks buy or sell government securities to control the money supply. Yes, they will buy or sell government securities like sovereign gold bonds, government bonds, T-bills, like these kind of bonds, T-bills, etc. They will buy these. This is called open market operations. Now, why will the central bank do this? Well, actually, if there's so much money in the market, but there's no way of circulating it, the central bank will buy some government securities and then use that money in a productive place. But if there's very less money in the market, then the central bank will sell government securities to earn money so that more money will be in the market for consumers to use. That is what open market operations means. Now, what is reserve requirements? Well, let's say you go to your commercial bank. Now, you deposit 100 rupees. Well, at that time, the reserve requirement is 10%. So the bank will only keep 10 rupees. The remaining 90 rupees is loaned out to someone else. Now, the thing is that the central bank can control the reserve requirement. So if the central bank increases the reserve requirement, then the commercial bank's lending capacity will be low, and vice versa. So the central bank can control the lending capacity through reserve requirements. Now, next comes the interest rate policy. Well, the commercial banks are kind of the copycats of central bank. Because just like we are the customers of the commercial bank, the commercial banks are the customers of the central bank. So, like, the central bank is just like the commercial bank to us. It will charge them interest on loans and it will give them interest on deposits. Just like how we get interest on loans, interest on the deposits, and we are charged interest on our loans. So the thing is that the commercial banks are the copycats of the central bank. Why? There's a very good reason behind that. Well, so the central bank has lowered the interest rate of their loans, of the commercial bank's loans. So the commercial bank will reduce the interest rate on our loans. Why? Because they will have more money to loan out, and so that's why they can reduce the interest rate, because then there will be no need for so much money. But still they will earn a profit. Of course they will earn some profit. But if the central bank will raise the interest rate on their loans, then they will raise the interest rate on your loans because they need to earn more. And if the central bank decreases the interest rate on their deposits, then they will decrease the interest rate on your deposits because they have less disposable income. But if the central bank will increase the interest rate on their deposits, then the commercial banks will increase the interest rate on your deposits because there is more money for the disposal. Now the government, as you guessed, have a complete different set of tools in their toolbox. First is government spending. Now government spending is the money that government spends on public goods and services like infrastructure, education, healthcare, etc. Now the thing is that, of course, the roads, buildings, hospitals, that you must have heard many government schools or government hospitals. So government hospitals is included in the healthcare sector in which the government invests. And the government schools are included in the education sector in which the government invests too. You must have seen many roads, and all those roads are built by the government itself. So that is included in the infrastructure sector. Now, I have created an entire video devoted to government spending. So I'll give the link of the playlist Government Money in the description, and you can click on that link and watch that video. It's a very long video, but it is very informational and very informative and will provide you with lots of information. And now, next tool in the toolbox comes taxation. Now, of course, we have to pay taxes on our income. Income tax, direct tax and indirect tax. Both of them are included in taxation. Well, direct tax is the tax like the income tax, which we have to pay directly, which we know that we are paying to the government. But the indirect tax is like the GST. Income tax and GST, almost everyone knows about them these days. Well, GST, goods and service tax, which are charged on the goods and service you buy. So GST is an indirect tax because you do not know that you're paying that tax. It just comes along with the price. So the government can increase the taxation or lower the taxation, affecting how much money you will spend in the market. Because if you have to pay more taxes, then of course you will pay less money in the markets. And the last tool is government borrowing. Well, government borrowing actually means that issuing bonds or taking loans to finance deficits or invest in long-term projects is included in government borrowing. Well, the thing is that issuing bonds might be new to you. Because issuing bonds, how is the government borrowing through issuing bonds? Well, of course they are borrowing. They are borrowing from us, the public, the common public. Because when we buy those bonds, we are actually paying money in the form of a loan to the government. And so the government pays an interest on that loan. But as we all know that government bonds are very safe and secure, we often buy those bonds for investments. And now loans, the government also takes loans from agencies such as the World Bank and the IMF. Now those are two different agencies which help the government at different times. And to understand them properly, you can watch my video, World Bank versus IMF. It is also very informative and I hope you'd like that too. And the link of Government Money playlist is in the description. That video is also included in the Government Money playlist. So, again, let us recap the things we learned. So, open market operations is the buying or selling of government securities done by the central bank. Reserve requirement is the amount of money which the banks keep of what we pay as our deposits. And if the reserve requirements increase by the central bank, then the lending capacity will become low, while the opposite can also happen. The interest rate policy, just remember it as a copycat policy, because the commercial banks are copycatting the central banks, for good reason. So interest rate policy is just that if the central bank increases the interest rate on the commercial bank's loans, they will do the same for us, and the same vice versa. And if the central bank increases the interest rate on the commercial bank's deposits, then they will increase the interest rate on our deposits and vice versa. Next comes the tools for the government for implementing fiscal policy. Well, government spending. Government spending includes the government spending on public goods and services such as infrastructure, healthcare, education, defense, etc. Taxation includes both direct and indirect taxes, and the government can increase or decrease taxes affecting how much we spend in the markets. Then comes government borrowing. Government can borrow money by issuing bonds or taking loans from the World Bank or the IMF, and so that money can be used to do government spending and can also affect how the economy of the country looks like at that time. So these were the tools. How will the central bank and the government be able to to implement monetary and fiscal policy. So now let's jump to the next scale. Which is the time frame. Now, monetary and fiscal policy have different effects. Monetary policy has short-term effects while fiscal policy has long-term effects. Why and how? Let's see. Now, first let's talk about monetary policy. Now, monetary policy has short-term effects. Why? Let's discuss about that. Well, you see, central banks can adjust monetary policy relatively quickly, often with short-term effects. Interest rate changes, for example, can impact borrowing costs and consumer spending in the near term, because after that, the consumers will get used to that interest rate, and then the old interest rate will be lesser than the usual interest rate. But now, fiscal policy has long-term effects. Why? Well, see, it will take a very long time to implement whatever fiscal policy decision will be there, because fiscal policy decisions such as changing tax rates or implementing new spending programs often require longer lead times and may take longer to have a noticeable impact on the economy. So, why? A good example is building a road. Well, first of all, the government will implement the order. Then they will employ some people for building the road. Then after that, they will find the raw material. Then they will transport the workers and the raw material to the site. Then it might take some time for the road to be built, like a few months or maybe a few years. And then after the road will be built, then people will start to learn about that road. People will first purchase the land next to that road. Then after that, people will come to that road. It will take some time to find out the exact location and then travel to that place. And then people will start setting up their homes there. It will take some time for the construction of the homes to be there. Then there will be shops there. And after some time, like a few years maybe, will a good change in the economy be shown, a good change in the GDP. And by the way, it will not be a very big change because there is just one road. Well, the government will build many roads, many places, but it will take some time. Of course, it will take a lot of time to see the effect of fiscal policy. So, monetary policy has short-term effects, but fiscal policy has long-term effects. Now let's jump to the next scale. Next scale is the scope of the effects. Now both monetary and fiscal policy have different scope of the effects. First, let's talk about monetary policy. Well, monetary policy affects the overall economy by influencing interest rates, credit availability, and money supply across different sectors. But fiscal policy is more targeted, focusing on specific sectors, regions, or income groups through changes in taxation or targeted government spending. Now let me explain both of these through examples. Well, let's say the central bank increased the interest rate of loans of the commercial banks by 3%. So then when the interest rate on the commercial banks loans increases by 3%, then all the commercial banks all across the country will raise the interest rate on the consumer's loan, the customer's loan, by 3% too, because they need more money. So it will affect the overall monetary policy will affect the overall economy by influencing the interest rate. But fiscal policy, well, it is more targeted, because if the government will change taxation, then it will change taxation in a specific place. All the places will not have the same taxes, because a poor state then will have more money, will have more taxes, while a rich state will have less taxes, Like in India, let's say Gujarat and Kerala, well, that they are not very equal financially, so it will be unfair for both of them to have the equal interest rate. The richer shall have more interest, a much more higher tax. Sorry, I have mistakenly called it the tax interest rate. Well, it just was a slip of my tongue. So the taxes will be more for the poorer state and less for the rich state. Well, the thing is that we should have a good tax system in which all the states will have particular taxes, because each state has very different financial positions. Sorry. So, anyways, even if the government will do government spending, let's say on infrastructure, roads, let's say, so the roads will be in a specific state, let's say in India, Gujarat. So it is targeted government spending. It will be more targeted, focusing on specific sectors, regions, or income groups. Now, I might have not made a very beautiful slide on this, but let me tell you about another scale: independence. Well, you see, independence in monetary policy, actually, the central banks are often designed to be independent from political influence. This independence helps maintain credibility and ensures a more objective approach to policy decisions. But fiscal policy is typically subject to political considerations and decision-making processes. It may be influenced by political priorities, electoral cycles, and public opinion. Because in monetary policy, it is the central bank that is deciding what to do, and the central bank is often free from the government influence. So political priorities will not play any role in monetary policy. I'm sorry. So in fiscal policy, the government plays a big role. So governments often have different parties, not parties, I don't mean the parties in which we enjoy, but you know what I mean. Well, those political parties which I'm talking about, like in India currently the BJP party, or shall I say Bharat Janata Party, is ruling as the government, and anytime in the elections one can lose a vote. Well, so this fiscal policy is often influenced by political priorities and others. Well, the thing is, monetary policy is not influenced by the government, or shall I say by political priorities. So that's it, all the scales discussed. Thanks and goodbye. I'll do the main thanks for tuning into my channel too. So now, let us summarize fiscal policy. Now, fiscal policy is a policy in which the government takes the advice of the Ministry of Finance. The government either lowers or increases government spending, taxes, or government borrowing, or a mixture of some of them. So, in short, monetary policy is the course of action taken by the government who control the economy by either lowering or increasing government spending, taxes, and government borrowing. Now let's summarize monetary policy. Now, monetary policy has short-term effects. In monetary policy, the central bank implements monetary policy. Sorry, it was just a slip of my tongue. So, anyways, where was I? Okay, let me again summarize monetary policy. Well, monetary policy has short-term effects. The central bank implements monetary policy. So the central bank controls the economy by controlling the money supply, increasing or lowering the interest rates, and buying and selling the government securities in such a manner that it is called open market operations. So before I go, let me give you one tip. you might have difficulty in understanding my videos. Maybe because of my accent? Nah, it must not been because of my accent, but it might have been because it was a little complicated for you to understand. So, one tip that I can give you is that always, whenever you find some difficulty in the words, you can search it in the web, and also you can listen to my videos again and again so that you have the clarity of the concept. This is a very important tip to understanding my videos, because to understand these kind of videos, these finance videos properly, you have to listen to it again and again, because it might be a little complicated for you to understand. So, thanks for tuning into my channel, Mini Money Mastermind with Mahira. I hope you found the information helpful in your journey to financial success. Don't forget to hit the like button and share my videos with your friends and your family so that they also can benefit from my content. I appreciate your support and can't wait to continue bringing you more informative and actionable finance related content. Until next time, happy money management. But before I go, let me again tell you today's quote. Quote. Well, today's quote is, our greatest glory is not in falling, but in rising each time we fall. Thanks for watching, and before I go, let me again remind you to like this video and subscribe my channel. Thanks, goodbye, and Jai Hind.